Jim Harvey, president of Opus 111 Group, and this is another installment of Your Money Week. Today, I really want to talk about commodities and the role of commodities and managed futures in being a good hedge against inflation. Now, of course, there are no perfect hedges, but commodities aren't pricing the same way that, say, financial assets price. Financial assets like stocks and bonds are priced on a net present to future discounted cash flow basis, whereas commodities are priced differently. So, for example, if there's a drought in Colombia, what happens to the price of coffee? Well, it goes up. Why? Because it's priced based on supply and demand. So, a drought would create issues about possible supply, which therefore means that demand will drive the price up. So that's an example, a very simplistic example of how commodities can affect and be part of inflation. Well, what are we seeing now? I mean, inflation has averaged over the last 30 plus years 2.1%. And you may be reading in the paper these days that the prints are 6.8 or even 7%. Now, part of that is comparing last year to this year. But what's driven that? Well, there have been supply chain disruptions, and that means there's a disruption in supply, which means that demand goes up and the price goes up, just the same way that we just talked about with respect to the price of coffee in Colombia. But historically, commodities have done way better than they have done in the last decade. So, for example, the 2010s, as you can see on this chart right here, it actually underperformed for the first time. Most of the time, going back to 1960, every decade, commodities have appreciated at least 75% or more, except, of course, during the 70s, when I was in high school and college, when it had a return of 1,400%. And you were like, oh my gosh, 1,400%, what would cause that? Well, you might remember something called OPEC. I was a junior in high school, so I had just gotten my license, and I remember driving to a line that was at least 2 miles long to sit there, and of course, with the engine idling, to go get 5 gallons of gas or whatever they were allowed to put up. So what happened there was that the OPEC countries consolidated and controlled what? Supply, and price went up. So commodities can be a really good buffer on that. So, that's one area. So right now we are suggesting to our clients, and we've always maintained having an exposure to commodities, and managed futures. But now we're actually thinking about increasing that. Why? Because inflation, we think, is going to be higher for longer than people think. Now, again, our industry tends to dismiss things and say, oh, well, let's go back to the historical norms. And right now, the Fed is still thinking that inflation will be 2.5%. We think that's way too low. A lot of people on the street are saying 3.5 to 4. We think it's more closer to 4.5 to 5. So as a result, having exposure to commodities are a good thing. First of all, as you can see, over the last decade, commodities are cheap. Secondly, because of the effects of the global slowdowns, global central banks have expanded their balance sheet, and commodities may potentially benefit from the inflation caused by this expansion. For example, in the U.S., the federal balance sheet has increased from roughly $4.5 trillion to $9 trillion. That's an over 100% increase. Now that sounds daunting, but here's a chart that you can see that looks at the increase from basically year-end 2019, which is just before COVID hit, to the year-end 2021. And while our Fed increased its balance sheet 110%, Australia's was up 260%, and Canada was up 318%. So clearly, it's not just the U.S. where central banks have expanded their balance sheet, and that may have an effect. So what are commodities and managed futures, and how can you get access to them? Well, we can use private partnerships, which we like because you can get direct exposure to futures contracts, but there are different kinds of commodities and managed futures. There's the commodities that everybody thinks about, pork bellies and cotton and soy and that kind of thing. Those are agricultural commodities. There are industrial commodities. There are industrial metals. There are precious metals. There are stock index futures and fixed income futures, bond futures. So all of these are areas, as well as precious metals, of course, that you can participate in the commodities market. So there are mutual funds that do them, there are ETFs that do them, and then there are the direct kinds of partnerships that you can invest in. So, consider whether you have an exposure to commodities right now. And one last comment that I think you need to keep in mind, and it's very simple. Often people will say, my gosh, every dollar has to maximize return. I get that. It's just not the way professionals look at portfolio construction. So we don't manage commodities because we think this year it's going to outperform some other investment. We manage it because commodities, not always, will zig when financial access zags. So, for example, one of the programs that we have invested in way back during the credit crisis, 2008, the S&P was down between March of 07 to May of 09, or sorry, October of 07 to March of 09. The S&P was down 57%, but commodities were up over 30. So it buffers, it dampens portfolio volatility, and there's all kinds of studies that have shown that. And you don't need a big exposure to commodities. So again, you wouldn't go in here and say, well, I'm going to speculate in commodities right now. But if you don't have it in your portfolio, then you've got a major portfolio risk dampening tool missing from your quiver. So with that, I will leave you. We encourage you to go to our website, to our Learn page, and listen to this podcast as well as other podcasts and blogs that hopefully will educate you so you can make smarter decisions with your money. This is Jim Harvey, president of Opus 111 Group, and have a great day.